Angelo, welcome to the show, man. We've waited a long time and we finally got you here. How does it feel?
Awesome, man. Thank you so much for having. I'm super excited and appreciate you for even thinking of me and inviting me to come on.
That's awesome. I'm excited to talk about something a lot of people are so interested in these days, and it's money. And it's more than
Yeah.
money, it's leveraging money. And that's kind of what gives us velocity in most of our investing plans here.
Right.
So I want to get into that a little bit. But first, tell us a little bit about how you got started into real estate and mortgage banking.
Yeah. Yeah. So it wasn't by design. So I grew up in a very humble upbringing, a very poor family in Texas, in Houston, struggling to make it. My father left my mother when I was in the sixth grade, so I dropped out of middle school to take care of my family. I had four brothers and sisters.
Wow.
So the idea of even owning a business, running a company, doing any of that just was completely unfathomable. And I was also, I weighed 400 pounds. I was 200 pounds overweight. So just no future, no direction. And then, a lot of bad things happened to us. We lost our car, we lost our house. And it forced me to hit rock bottom. I had a heart attack when I was 18 years old.
Holy
And the
man.
biggest catalyst to me was the movie Rocky. And that movie was the turning point for me that helped change my life. And it gave me a reference and precedence that if anyone can change and become, on top of the world, that you can do it. And it gave me the positive proof that could actually happen. So that was like the catalyst to help me to get in shape, change my diet, lose the weight, go back to school. So I went to school for finance and economics, studied Warren Buffett. And I ran into a very old friend of mine that was actually in mortgage, and I hadn't seen him like in 6 years. And this is before the subprime crash. And he was living on top of the world, just, making big money, big life, the whole thing. And at that time, I didn't even know what a mortgage was. So I came and worked with him for a little bit, shadowed it. And the name of the company at that time was 𝗵𝗀𝗀𝗃 Mortgage. It was the biggest subprime lender in America in the 2000s. So anyway, learned the business, fell in love with it. They were the biggest subprime lender. They had a call center set up. They were doing basically like hard money, subprime cash out loans. And they had a very systematized, very organized model that I fell in love with. Not the products they were doing, but the system, the structure with the call center made a lot of sense to me. So I went out and did my own brokerage and went through the subprime crash and then kind of scaled and pivoted through the market as it ebbed and flowed. When we had the crash, we got out of subprime mortgages, got into FHA, and just kind of, toggled around and pivoted with the market and kept growing. At this time in my career, I was just doing residential mortgage. So I was not doing hard money. I was not doing commercial. So from 2005 to 2015, it was just residential. So that's kind of like the backstory that helped me to kind of build the foundation for the whole company today. Yeah, so subprime is basically at that time uh, in our history. Let's say I'm 44. I feel like that was when I was 22. That is a loan that basically is not a conventional loan, like you can go get, to get from a bank, where there's either blemishes or issues with the credit, and it's not underwritten by Fannie Mae or Freddie Mac or FHA. It's usually a private investor that's making that loan, and it has a higher premium, a higher price. Give an example, someone that wants to buy a home for $500,000, they got a 540 credit score. Obviously, they can't get approved from a bank with that credit score. So at that time in the era in the 2000s, early 2000s, you could go and get a loan, even get 100% financing. Now you didn't get the going rate, which was 6%. You got an 8% or 9% rate, and you were charged a few points. But a lender would make that loan to somebody in that situation. So that was called a subprime mortgage, because prime means, prime, like prime beef, like grade A. Subprime is below that, which is basically a higher risk, but also a higher return to the investor. And it created a several $100 billion, trillion-dollar market at that time. So the way that it works, well, there's two things. On the standard lending side, the conventional primary residence, those loans do not stay on our balance sheet. Let's say we're going to do a $20 million loan in Miami. that loan is sold to an end investor within 3 weeks after we close. We don't have the capacity to keep that size of a loan on our line, right? So it's called a warehouse line of credit. So that loan, as soon as we fund it as the lender, will get sold off to a bank or an end buyer that buys that holds that debt. Now, a commercial or hard money loan will stay on our balance sheet, and those loans are usually under 2 million or whatever, and we'll keep the spread on those and the points, and then we'll service those loans because it's something that gives us a higher yield. But those loans are much smaller on the private commercial side versus the standard jumbo mortgages. And so obviously, if you think about it, I mean, the mortgage industry is probably one of the biggest industries on the planet, and trillions of dollars. And back in the day, when you went to the SNL, the savings and loan, to get a loan, you sat down with your banker like in 1910 and talked to him, did a handshake deal, and you bought your house, got a loan. And obviously, as America was growing, they noticed that there was a liquidity event where we're running out of money and banks don't have the money. And so FDR created, the Federal Housing Administration to help to facilitate the flow of capital and to originate mortgages. So all it is basically for conventional loans only, a conduit or outlet for banks, credit unions, mortgage lenders to originate and sell their loans to. So, got to give you an example. Let's say that a bank originates $100 million of conventional loans, right? They need to get their money back. It's on a line of credit. So they will sell those loans to Fannie Mae, that $100 million, to replenish their capital. And then those will stay on Fannie Mae's books. But Fannie Mae is the end buyer of these loans. They establish the covenants and the guidelines for what the lender as me can originate. So like if they say you have to have a 620 or higher credit score, I have to follow their requirements for them to purchase the loan. Otherwise, they will not purchase the loan. So since they're the end investor, they call the shots because they're the ones that are buying the debt. A lot of people got their loans a while ago when rates were low. We get this call probably 80 times a day. Hey man, got this rental property. It's worth $1 million. I owe 300. I got a 3% rate. I'm not touching the first because the rate's too low. I mean, you probably hear this every day. Mm-hmm. Well, what's come out, what's been created is a second lien HE loan or HELOC, and you can even do stated no doc on investment property. So let's say that, use an example, the property is worth $1 million, you owe 300. We can give you a second mortgage behind the first. You don't have to touch the first, so the prepayment penalty is never touched. The first mortgage rate's never touched. We'll give you a line of credit or a second mortgage of $500K behind the first mortgage, so you can take that to do your investments. And you can get a 30-year fixed loan. The interest rates right now are starting at 7%.
Oh, wow.
Yeah. So, and then you can either, if you do a line of credit, then obviously that works just as a revolving line, and there's a 10-year draw period, or you could just do a 30-year fixed HE loan, which is just a cash out mortgage. So everybody right now that I know that has equity is doing that.
Interesting.
Yeah. And it can be for your primary residence or a rental property.
And you said HE loan, not HELOC.
Well, there's two of them. There's a HE loan, which is it's a cash out mortgage. There is no line of credit feature. It's just you lump sum payout, you repay. So there's a HE, HE loan. It's called HE loan. And then the other one is HELOC, which is line of credit. And that is where, if you pull money out, you can pay it back, and you can keep going back and forth for 10 years and draw and pay back. So some people like that feature. Now those are harder to qualify for. They have more stringent requirements for a HELOC with the credit, income, and debt ratio versus a HE loan. I have one of my clients I got to go meet with him after this show. He has a $240 million real estate portfolio, the biggest landowner actually in Galveston County in Texas. Wow. And I have the next customer next to that that's just trying to get into this and start it. And the biggest thing that I see, obviously, of course, is experience. But there's a tremendous amount of confidence in the large investor. They have this amazing faith and belief in what they're doing, but their ability to take on risk, they're not scared. Okay, they can handle risk that's calculated. And I see like the entry level people are starting. They're very nervous. They're very worried. Their focus is on what if it goes wrong? What if I lose it? What if I can't make it? So their belief in themselves is way lower than the person that's built this massive empire, and rightfully so. So I think that having the confidence, and how you build confidence is obviously through experience. And so putting yourself in these networks, going out and jumping into the water, and it's okay to fail. It's not, you don't be scared to fail, but learn the lessons and get yourself around the right people so that the failure isn't catastrophic. Because what you don't want to do is you don't want to bet the farm and lose the farm. That's why you put yourself in the right group so you can be successful and you can minimize the hemorrhaging of the risk that you take. But all the guys I know that are super wealthy, far wealthier than me, their ability to take on risk is just like, once they can look at something, make a calculation, hey, yeah, I'm in it or I'm out, and then allocate the capital, and then let it ride, So, and people that are new, they're not sure, they doubt themselves, they don't want to take it, they're worried about everything.